Welcome back to Financial Clarity for Doctors, everyone. Rochelle Van Der Zanden here with Corey Janoff.
Yo, yo.
It's great to have you back. Today we're going to talk about some stock market fun. We're actually recording this the same week that all the GameStop craziness and all that stuff was going on, so it's kind of a funny time to be talking about this. But we are going to spend a little bit of time today talking about timing the market and trying to figure out when to buy and things like that versus just having time in the market, which is two different things, even though it sounds exactly the same. We do have a lot of clients that come to us really concerned about investing in a market like we have right now, where we're trading at all-time highs and no one knows when we're going to get hit a peak and maybe come back down a little bit, and no one wants to put all of their money in the market or make a big investment right before we have a big decline and see their money come down a little bit. It's really hard to try to time things like that. So we can try to take an educated guess, but in the end, a lot of times our educated guesses end up being wrong anyway. So there's a lot of times not a whole lot of a point to try to time the market. Instead, we want to focus on the things that we can control. We can't control market cycles, but we can control things like how much we're saving, when we're saving, how much we're spending, all of that kind of stuff. Those are the things that we have control over. And so those are the things that we want to spend a little bit of time talking about today. And we also want to just give you some examples of things that illustrate this point, because it is kind of counterintuitive. You think it really matters when you're putting your money in the market, but it doesn't matter as much as you think. So Corey, you want to launch us a little bit and talk a little bit about a few examples?
Sure. Yeah, I think you hit on it to start off. The how long you are invested is probably a much greater predictor of investment growth and wealth accumulation than the exact timing of when you put money in or pulled it out or what specific holdings you purchased. Like you said at the beginning, it's kind of ironic the timing of when we're recording this, because we usually plan these podcasts several weeks out and then record them about a month before they get released. So who knows what the world's going to look like a month from now. But the week we're recording this is when the GameStop and AMC and several other companies were their stocks were a battle between Wall Street shorters and the subredditors trying to pump them up, and a lot of humor on Twitter. But for those of you looking at day trading and trying to time the market and get in or out and make a quick buck, it's basically gambling. You might as well go to the casino and do the same thing, because it's more or less what you're doing. If we look from this week, if you put 10,000 into GameStop or AMC on Monday, you might have sold it for about 30,000 on Wednesday. Not a bad turnaround in 2 days. Granted, you have to pay short-term capital gains taxes, which is ordinary income rates on that money. So make sure you set some aside for the following April. But you also could have bought on Wednesday, for 10,000, and then Thursday sold for 5,000. So you just never know what's going to happen in the future. So it definitely is risky. And what do they say about gambling? The house always wins. So even the most successful bettors out there only win, and we're not talking like roulette, but like poker players and sports bettors, where there's actually, some people have a chance to argue there's a skill component to it, but even the most successful ones win just over 50% of their the bets they place. So it's not quite the same as investing. It's for entertainment purposes only, as all the disclosures out there will tell you. Whereas investing, and I'm sure some people would love to argue with me on this one, but I'll stand my ground. And I would consider investing owning assets or companies that produce revenues and participating in the ever rising profits and dividends that they produce over the long haul. Now, no guarantees that those profits or dividends will rise, but if you look at history, things have tended to increase over time. Again, no guarantees moving forward, but if you're in it for the long haul, there's a good chance that 30 years from now, the stock market will be higher than it is today. If it's not, we're all in this boat together. We got probably bigger things to worry about, but yeah, look for revenue producing assets, whether that be stocks or businesses that you own, whatever, and just participate in their income streams and revenues over time and reinvest your dividends. And you can't really control what the end result will be, but you just have to have faith in the process.
That time component is so huge. I do like you put a couple of examples together here, and I love the Warren Buffett example because everyone thinks of them as this investor that was so successful from a really early age, and he just has magic or something like that. Like that's how people think of Warren Buffett. But he actually accumulated a lot of his wealth later in life because of that time component. Like he needed to be invested for a certain amount of time before he really saw that compounding growth happen. So some statistics on Warren Buffett specifically, like 99% of his wealth was accumulated after age 50, even though he started buying stocks at age 11. Like that's a lot of years to be invested. And then about 90% of his wealth was accumulated after his 5th birthday. He's been investing a very long time, but most of that wealth growth was very late in life. And I think the lesson there is just the earlier you can start, the better. And the more that you can get into the market early on, and the longer you can go without touching it, the better it's going to be. Like if we don't tap into it, it's going to keep growing for us. Or ideally, we hope, again, can't predict future performance, but if things keep going the way that they have in the past, then we could expect the same sort of thing. Not Warren Buffett returns necessarily. You got to put a lot away to be Warren Buffett, but I think he was worth like 250 million at age 52 in 1982, which is crazy. He was still one of the richest people in the world at that point in time, but he's worth so much more now. Now it's like 7.9 billion is how much he was worth before he turned 65 in 1984, which is still a long time ago, but that's billions, not millions at that point.
94,
And
I think.
yeah,
All good.
94. Yeah, I thought that was what I said, but I didn't. And then Bill Gates became the richest person in the world right around the same time. But today, Warren Buffett is worth $8 billion, and Bill Gates is worth like $122 billion. And then we have, Jeff Bezos, the wild card, and he's in there with 190 billion, which is a different kind of way of earning money and seeing your wealth accumulate. But that's kind of the wild card there, where, if you're on the cutting edge of a new industry that's just taking over the world, if you could do that somehow magically, you might make a lot of money too.
There you go. Yeah, it's pretty impressive. 250 million from the early 80s to call it in the mid 90s, he was about 10 billion. So pretty
Mhm.
impressive. But then from the
That's
mid
huge.
90s to today, 25 years, 26 years or so, he's gone from 10 billion to almost 90 billion. And he was what, 65 years old he turned 65 in the summer of 1994. So right after the Forbes comes out with their annual lists every summer. So yeah, it's time. Like just letting your investments continue to compound and grow. And it's pretty staggering looking back. We look at these billionaires today, the richest ones are in the 100 billion range, but back in the 80s, like there were maybe a few billionaires, but 250 million was considered one of the richest people in the world at that time. In the 90s, single digit billions were the richest people. Like Bill Gates was, I think, the first one to cross over the $10 billion mark when Microsoft started taking off in the mid 90s. And it just goes to show you that time is a magical. That's probably where all the magic is. I mean, yeah, Warren Buffett's a very skilled investor and better than most anyone else could ever dream of being. But still, his greatest attribute is just time. He's been investing for 8 decades. So he's 90 years old now, and he started at age 11. So good for him. And he says his biggest regret in life is not investing sooner. Like,
Like
he
I should have
wishes.
started when I was 8.
Yeah, right. Think how much he'd be worth now if that was the case.
I love it. Yeah, I mean, I think sometimes when we talk about these numbers, they're just so big that they're really hard to understand. So that's one thing. Like, I think it's really hard to communicate. Like these are huge numbers. You could work for thousands of years and not have the amount of money that these folks have, even
But,
as a doctor.
but we don't need that much, which
No,
is,
uh-uh.
we'll wrap up with that. But how much is enough? And I know Buffett plans to give the majority of his wealth to charity, along with a lot of the other billionaires and richest people in the world. They've all signed that giving pledge to give away the majority of their wealth, either in their lifetime or when they pass. But another example that I found very interesting, not sure if any of you are familiar with Ben Carlson. He's a CFA and author on the Wealth of Common Sense blog. There's some good stuff on there. And this one that he wrote was from a handful of years ago, back in February of 2014. He actually did a scenario to look at someone who only invested at market peaks. So like the traditional stereotype is investors wait till things look good and then they get in, and then things turn south and people sell out. So they buy high and sell low, which is the opposite of what you want to do. You want to, I don't know who said it, but be fearful when others are greedy and greedy when others are fearful. So when stocks are at a low point, that's that. If we're going to do any timing, that's the ideal time to buy. We just don't know what's low and what might be lower, or when things are going to go up and then turn. But anyways, in his blog, it was called The Worst Market Timer, and he did look back at historical market prices, and he said, okay, let's take someone starting in the early 70s, pretend they're starting their career out then, and in 1972 they put $6,000 into an S&P 500 index fund in let the market, and then the market crashes right after that. Like 73, 74, the market was down, I think about 50% or something. Same thing, 1987, August of 87, market's at a peak. He puts 46,000 in and then takes a nosedive. December of 1999, next peak of the dot-com bubble, put $68,000 in, and then things slide for 3 years straight. And then in October of 2007, at the peak before the big '08 crash, puts another 64,000 in right before the market decides to go very far south. So in total, through those handful of big bear or big bull market peaks, he invested $184,000. And here's the key: he never sold. He just let it ride. Let the dividends reinvest. And for the simplicity of this example, we're assuming no fees, no taxes, which in reality those would be applicable. Also, you can't invest directly in an index. You'd have to invest in an index mutual fund or ETF, which have costs and expenses, but yada yada yada. For the example purposes, let's not miss the forest for the trees here. So invest 184,000 in total only at market peaks. In 2014, that would be worth 1.1 million if you just put it all in the S&P 500. So even if you're the world's worst market timer, investing 184,000 still would have grown to 1.1 million. And I did the math for what it would be worth today. So end of January 2021, it would actually be worth 2.6 million. So yeah, it just goes back to show you time. Just stock market's a volatile, crazy, dangerous place, but if you give it time heals all wounds. No guarantees, of course, but there's a good chance that the losses will recover, market dips will rebound, and you got to give your money a chance to grow. Otherwise, you won't participate in the growth. So just leave it alone once you make your decisions.
Yeah, like the timing of your purchases is not nearly as important as not selling when you get scared. Like that's such a big key there. Like obviously if he had sold at any point, if he was buying it at market peaks, that would have made this picture a lot different. Yeah. And we can kind of bring it back to like for our listeners, what does this look like? What does it mean to just be investing strategically and controlling the things you can? So if we just take a hypothetical example of an attending physician with kind of a median income, let's assume like $250,000 a year. We've talked a lot about working towards saving 20% of your income for retirement, just to kind of make up for that lost time. Like we're just not really able to save a lot on the early end when you're in med school and when you're in residency and you don't have a ton of excess income. So when you do get to that point where you're making a little bit more money, we got to prioritize saving a good chunk and saving fairly early. So let's just assume that from age 32, when you finish training, until age 62, when you retire, you save about 20% of your income. And let's say that's $4,000 a month. And then we'll just assume about a 6% average rate of return net of all costs and taxes. So there's a little bit of costs, there's a little bit of taxes. 6% is fairly conservative. Again, we don't know exactly what returns are going to look like, but we have to pick a number for an example, and that's a good conservative number.
I
So
think
if
to
you,
highlight right there
yeah,
really quick is just it's not going to be linear. Like you will never get a
yeah,
linear return trajectory on your investments. Like one year it'll be up 21%, next year it'll be down 15%. Okay, there's an average of 6, but it's kind of all over the map. So expect a roller coaster ride over time. Rarely will you ever have a year where your portfolio actually grows by its quote unquote average.
exactly, yeah.
A lot higher or a lot lower.
And a lot of times during the year, you're going to see a big decline, but you might still end up the year with an increase. So it's really interesting how all that happens. But if we're just investing, we're just putting that $4,000 away per month, we're not taking anything out. You at age 42, assuming that kind of savings rate, you would say you would have about 655,000 invested. At age 52, you'd have about 1.85 million. And at age 62, when you go to retire, you'd have a little over 4 million if you're saving $4,000 per month. And then let's just say you don't need your money in retirement and you just let it ride just for fun. Let's say you retire at age 62, so you're not investing anymore, but for some reason you don't need to take it out. You're living on your tiny, tiny, tiny social security, or you're sleeping on your kid's couch. Like you just want to let it ride. At age 72, we would expect that initial investment. So you haven't put any extra money in since age 62, but we would expect it to be worth about 7.3 million using that 6% rate of return. At age 82, 13.3 million. At age 90, which is Warren Buffett's current age, then maybe you'd have about 21.5 million if we didn't have to take it out for retirement. And obviously, that's not what we're intending to do with our retirement money. We're not intending to let it ride, but it's kind of interesting to see what it might do if we did. But as you start to take out that money, obviously you see it start to dwindle and things like that. But if you're saving 20% of your income and you retire with like that level of income and that level of savings, you should be in a pretty good position. Obviously, it's all dependent on personal circumstances, but we would expect your expenses to be lower than they were while you were working, probably, and things like that.
Hopefully.
Hopefully, you're not having a giant mortgage payment anymore.
Kids are out of the house, and yeah, expenses are student loans will hopefully be paid off. So a lot of it should cost you less to live in retirement than today. And I mean that, the stop working or yeah, we stop investing, but maybe we don't stop necessarily working. Like you could work part-time from your early 60s to mid 70s, 80s even. Maybe you're doing something fun. You're doing some consulting or research, or you're teaching med students 1 or 2 days a week and just earning enough income to cover your living expenses. Like, I know it might be a little extreme, but that scenario isn't out of the realm of possibilities. So investing diligently and persistently for 30 years, and then get a part-time gig to cover your living expenses and keep your mind sharp, and let the rest ride. You could turn 4 million into 20 million before you leave this earth.
Mm-hmm. And there are a lot of people that want to leave some sort of legacy, whether it's for their family or for a cause that they care about. And there are definitely ways to do that if you're living like well within your means or under your means. And yeah, I think we're going to come back to this a little bit, but really, like having more isn't necessarily the thing that's going to make you happier.
No. And
Yeah.
one example that I really like, but I don't know if it's true. I tried fact checking it and I couldn't find like any like legitimate sources that would confirm it or find it directly from the source, but I've heard and I've seen numerous times people cite a study that Fidelity did, and again, not sure if it's true or not, but I wouldn't be surprised. Apparently, they did an internal audit, which would make sense that they wouldn't publish it if it's an internal audit of accounts. But they did an internal audit over a period of a decade in the early to mid 2000. I think it was like 03 to 2013 or something. Anyways, they found the best performing accounts held at Fidelity were accounts that people forgot they had owned or were owned by dead people. So
I kind of love that so much.
again, not sure it's true, but I found a number of blogs that like went back and tested the theory. Basically, like if you just put money in and didn't touch it, not at all. You don't even like rebalance. You just leave it alone. Then you would end up performing better than most of your peers who are perusing the subreddits and following the Wall Street Bets accounts and hashtags and trying to, make adjustments here and there to capitalize on opportunities and avoid pitfalls and move money in and out. Again, there's definitely a strong argument and studies that show rebalancing adds value. Making minor strategic adjustments to your portfolio can add value over time. But the biggest thing is you got to stay invested. If you're making those strategic adjustments, that's not pulling money out and waiting a month to get back in. It's shifting maybe from large cap to small cap a few percentage points here and there because you're overweight in the large cap sector for whatever reason. So the key is just leaving the money invested, letting it do its thing and compound over time. And if history is any indicator, no guarantees moving forward. Full disclosure, compliance people who review this before it gets published, no guarantees, but it's at least throughout history, that's been the case. If you just leave it alone, it'll end up higher than you started over a long period of time.
Definitely. I do love that. It makes me it makes me happy. But it's partially just because people are selling. Like you can't sell if you forgot about your account. You can't sell if you're not alive. So I feel like that's like the bottom line of the story. Don't try to sell, don't try to change things too much. But yeah, good times. I do think that a lot of this also comes back to like trying to control the things you can control. And the things you can control are how much you're spending. And, like obviously we have some things that we have to spend money on. We have to make our student loan payments, but we can control how big of a house we buy. We can control like what car we drive. We can control whether we spend $3,000 a month on groceries or one. Like we can control things like that. And if we can control our consumption and therefore like save a little bit more for retirement and put our future selves in a good position, like I think that overall is going to lead to hopefully more satisfaction because like there have been numerous studies that have shown above a certain compensation amount, above a certain income level, you're not necessarily happier at that point. So if we're not necessarily happier because we make $250,000 worth versus $200,000, maybe we live like we're making $200,000 and the rest can go towards other goals that we have, like the retirement or college savings, anything like that. So if it's not making you happier really, then maybe we can choose to direct some of those resources elsewhere.
Yeah, that gets into the financial independence piece, which can mean different things for different people. But if your expectations of what your lifestyle should be rise faster than your income or your net worth, it's going to be hard to achieve financial independence. So you got to ask yourself, at what point do I have enough? At what point do we have the things that make me happy and the rest is just smoke and mirrors? We were talking before we were recording, like, a lot of people say the best time of their life was when they were in college. And it's kind of true. College was great for a lot of people. Some of you, maybe not, some of you were probably just on a mission to get to med school and you were miserable studying all the time. But for a lot of people, you had a lot of fun in college, and you didn't have really any income. You were sharing a room, eating top ramen, drinking awful beer, but you were having the time of your life. So money isn't everything. Yeah, it's a good down payment on happiness, but at some point, you got to ask yourself, do I have enough? Do I have all the essentials, and am I living comfortably, and what really makes me happy? And for most people, it's being able to control their time and live on their own terms. So if you can do the things you want to do with the people you care about, when you want to do them, that's about as good as it gets. And you don't need to be a billionaire to get to that point.
Mm-mm. And I think for a lot of folks, being able to work less earlier on is something that they'd like to achieve. And it's just another way to do it. If you're spending less now, if you have a standard of living that's fairly sustainable long term, that allows you to save more, but also maintain that after you retire without doing anything to reduce your consumption. I think that's really helpful. And then you can have more flexibility to spend the time and your time the way that you want to. We always get so philosophical, Corey.
Yeah, I mean, the math part's the easy part of all this. It's the psychology and philosophy of it all that's the challenge that people grapple with and keep them awake at night. So,
yeah.
But yeah, moral of the story, just stay invested. Don't try and time the market. If you want to time the market, sure, open up a play account and have some fun with it, but basically treat it as your gambling money. It's for entertainment purposes only. And yeah, I guess if you hit it big, but even I don't know anyone who's been a day trader that turned into a massive success and could afford to retire and quit their day job. If you're day trading, yeah, you might make a couple $1,000 here, a couple $1,000 there. Maybe you get crazy and put 50,000 on a stock and it turns into 100,000. But most people are just putting a couple thousand here and there, and the big stock success stories, you have to be invested over a long period of time. Yeah, if you put money into Apple back in the late 90s or early 2000s, 20 years ago, maybe you could retire today. But it still took 20 years to get there. It didn't happen overnight, and they had some big declines along the way. So there's very few get rich quick schemes, and very few companies, investments, whatever that will really pop over a short span. It takes a while to really ramp up and matriculate. So
moral of the story, focus on what you can control. Try to be happy with what you have. Prioritize the things that really make you happy.
Yes.
And the rest is gravy.
Well, thank you all for listening. Thanks for the feedback. For those of you that email us and ask for request certain topics to be addressed, we got a few of those coming down the pipeline here. And appreciate all the reviews and ratings that you've given us on the podcast apps. Really helps other people find us. So have a good one.
Thanks, everyone.
We would love to hear your feedback and suggestions for future topics you'd like us to cover. You can get in touch with the show by emailing podcast@thefinitygroup.com or by following Finity Group on Facebook, Twitter, Instagram, LinkedIn, and YouTube at Finity Group LLC.
You can follow me on Twitter at Corey Janoff CFP, Instagram at Corey Janoff, or on LinkedIn under my name, Corey Janoff.
You can follow me on Twitter at Rochelle Finance, or on Instagram, Vanderzanden Rochelle, or on LinkedIn under my name, Rochelle Vanderzanden.
Check out all of the podcast episodes on the finitygroup.com/podcast, on our Finity Group YouTube channel, or your favorite podcast app. And don't forget to check out our financial clarity blog at thefinitygroup.com/blog.
Thanks for listening to this episode of Financial Clarity for Doctors by Finity Group LLC.